I work at Prepare and Prosper, which is a nonprofit in St. Paul, Minnesota, so Midwest based, and we are excited to share a little bit about Taxes 101 today. I'm going to hit the highlights of some tax information that hopefully builds a little bit of comfort and confidence for those of you that are not already tax experts or feeling like you've got the basics down. And as Jenny said, we're going to have lots of time for Q&A, but feel free to put your questions in the chat before we get to that point, and then we can bounce back to those, or I might just pick them up as I'm going through the presentation, and then we'll have lots of time to discuss afterwards. So during my presentation, I'm just going to cover kind of basically what are taxes, then we're going to jump into income tax return basics, and then shift right to that Q&A. So short presentation, kind of lay out the groundwork for how taxes function. So what are taxes anyway? These are payments that we give to the government. So all of us folks in the world, we are paying taxes to our governments that are used to provide public goods and services. So things that are building up our communities, keeping our administration of our country running, or our state, our locality. Taxes come in a number of different ways. And we as citizens pay them in a number of different ways. So we might be paying an income tax based on the amount of money that we take in during the year, sales tax when we buy things, property tax when we own different property. And this is a lot of different ways that we are contributing to the government and the public goods and services that are coming through. This time of year, we're most commonly talking about income tax. And so that's what we will spend more time on today. But all these taxes that we pay and contribute into this collective kitty are being used to, like I said, just support this regular government function, build roads, pay for Medicare, support our Social Security system, give the military the funding that it needs, support our schools, and many, many, many more things that we are all paying for collectively so that our communities have access to these public goods. So that in a nutshell is what taxes really are. And like I said, this time of year in the January through April period, we're most often talking about income taxes. And really when people think about income, or when people think about taxes, they're most often thinking about it that way. But I do like to share that broader sense of the definition of taxes, because we're all paying taxes throughout the year in a lot of different ways. So keeping that in mind, that income taxes are not the only place that this money to support our government comes from. But income taxes are a big part of it. And we in the United States have a voluntary compliance tax system, which means that we send in our tax returns annually so that the government can take a look and help us decide how much money we owe them. And the income tax return that we use is called Form 1040. This is what the basic form looks like. And perhaps you're familiar. If you filed your own tax return, you might have looked at this big long form and been like, my, that's a lot. And it is a lot. Our income tax return collects a whole bunch of data on us. It's collecting something called filing status, which we'll cover a definition for really briefly in a minute or so. It collects a bunch of personal information about us: birth dates, addresses, phone numbers, social security numbers, and our contact information. It also collects information about dependents, so people that we support, our income. Because it's an income tax return, it collects a lot in that arena. And then it collects information about deductions, so special tax situations or life situations that we have that let us decrease our income and decrease our income tax. Actually calculates our tax, and then also collects a whole bunch of information that might make us eligible for tax credits. Hopefully we have a refund calculated at the end because we've already paid enough taxes throughout the year. And then direct deposit details are also tracked on this form, and then a space for signatures. So all of that information is showing up on this beautiful form. Some people have more complicated tax situations that add additional forms to the income tax return, but it all comes back to this lovely Form 1040 when we mail it in or send it in electronically. Lots of ways to send your taxes in. So we're going to jump into a little bit more detailed definitions of a few of these terms to help build our comfort with discussing taxes and maybe helping people get connected to resources they need to do their taxes or collecting the information they need to get them done. So on our tax return, we are going to be collecting information about filing status. This is a little bit complicated. Like when I train volunteers on this topic, we spend about 40 minutes talking about filing status. But in general, a filing status is determined on your marital status and some household components, like how many people you have in your family, if you're supporting people. And this determines a few different things about your taxes, your tax rate, so how much you're taxed on the income that you have, also your eligibility for some tax credits. It also helps determine if you have to file a tax return or not based on the income level that you have. So filing status is really a core component of your tax return, and there's a lot built on that. And then filers can claim dependents on their tax return, and a dependent is often someone that lives with them, but not always, and will be somebody that's financially supported by the taxpayer. So that term dependence, I think it gets thrown out there a lot. And I encourage you all to think about this a little bit more broadly than kids under 18. It might be parents, it might be college age students, it might be that cousin who's unemployed and has been staying with somebody for a really long time. So the definition of dependence does go beyond little kiddos in the household. And then other things that we see tracked on the income tax return, Form 1040, income as defined as money that's coming in. Most often, money that's coming in is going to be taxable. And then you report it on that Form 1040. There are a number of exceptions to that rule. But when you are talking to somebody or doing outreach about taxes, think about any money that's coming in. They should probably have documentation of that and be ready to present it as needed when doing a tax return. Then tax filers can often claim deductions or will always claim some deductions, but their tax situation is going to depend which ones they get to claim. There's a set of standardized deductions for people based on a filing status, and that's going to reduce how much taxable income people have. So on the tax return, we report income, then we take out deductions, we figure out what people's taxable income looks like. And this is specific life situations might contribute to your deduction. So having student loan interest that you paid during the year, making charitable contributions. This is, I think in common language, a lot of people talk about writing things off on your taxes or having a deduction for that. This is where that fits in, reporting your income, subtracting out deductions before we get to the amount of tax that somebody owes. So again, on the tax return, as we kind of move down the Form 1040, we're going to figure out how much income someone has, take out their deductions, and then we're going to figure out their tax. And this is the amount that somebody owes in taxes based on their income for the year. And we have an income tax in our country that is kind of a graduated income tax. So people, the more you make, the higher your tax rate is, which means the percentage of, based on your income, the percentage that of tax that you pay is a little bit higher. And then after we figured out how much tax you owe, we're going to figure out if you're eligible for credits. And so we are looking at very specific life situations like having kids or people going to college. Those are going to be situations that might qualify someone for a tax credit. And tax credits are then used to pay for part of the tax. And tax credits come in two different kinds. There are non-refundable tax credits and refundable tax credits. Non-refundable tax credits just go to pay the tax that somebody owes. So if somebody owes $1,000 in taxes and they have a $500 credit, they're still going to owe $500 in taxes. If somebody has a refundable credit, if that credit is more than the amount of tax that they owe, they're going to get that money back. If someone has a non-refundable credit that is more than the amount of tax that they owe, they don't get to claim the excess credit. Non-refundable means you can't get the money back. Refundable means that's money back in your pocket if it's more than the tax you owe. Kind of wish I had an example up on the screen for that. It's better when illustrated or easier to understand when illustrated. But credits kind of gets us to the bottom of a tax return. If somebody is due a refund at the end of the calculation process for reconciling their credits and their tax, then they can put in direct deposit information to get that refund via direct deposit. If somebody owes additional tax when it gets kind of to the bottom of the calculations, then they can make a payment to pay the rest of their taxes for the year. Well, that kind of gets us to the bottom of the 1040. And I think now it's useful to talk about who has to file a tax return. So certain people are required to file a return each year. And generally that's based on how much income people have. So if people have income above a certain amount, they have to file. For 2021 taxes, that's $12,550 for most single filers. And for most married filers, it's just over $25,000. So if people have income over that amount, they have to file a tax return. There's also some special situations that change that filing requirement. So if somebody is being claimed as a dependent on someone else's return, maybe you have like an 18-year-old who worked, but their dad is still going to claim them on their tax return. That person is going to have a slightly different requirement for filing. And self-employed individuals is another really common situation where people would need to file even if their income was lower than the general filing thresholds for being required to file a tax return. Along with people that are required to file, there's a lot of people who just should file a tax return. And this is people that had lower income. So maybe they made $5,000 during the year, but they paid some taxes. They had tax withholding. They paid the federal government or they paid the state government some money throughout the year. They're going to be able to take that money back because they paid too much in taxes. Their income is low enough that they didn't have a filing requirement. So they're going to get the money that they paid in advance back. And then if there are people who qualify for tax credits, they should file their tax return. This is looking at like the earned income tax credit. So if people had some wage income during the year, don't have a filing requirement, but they can file, report their wage income, and claim the earned income credit coming back. This year, this second point for qualifying for refundable credits is really important to shout out because folks that claim to the child tax credit advance payments need to file their tax return so that they can claim the other part of their child tax credit. That's a refundable tax credit. Even if they made no money during the year, they're going to be able to file the tax return and claim the rest of that child tax credit. And then there are some folks in that pay estimated taxes throughout the year. So if folks don't have a filing requirement, but they made those estimated tax payments, then they should file to get that money back. I see this most commonly with seniors who were accustomed to making estimated payments based on their previous income situation, and they've continued making estimated payments even though they're not required to any longer. So I see that relatively frequently with that demographic. One thing that I really want to emphasize right now is that folks should file a tax return, even if they're not required to claim the tax benefits that they qualify for. There's not a punishment if people haven't filed in the previous years coming up to this, if they didn't have a filing requirement. So for example, if somebody had $3,000 of income the last couple of years, that's what they have this year. There's no punishment for them not having filed in the previous years. We just want to make sure that folks get filing so that they can claim the tax benefits that they are owed. Start this year, start now, so that folks can jump into that system, claim the tax benefits that they are eligible for. And if we do continue to see some direct payments coming to folks for having children listed on their returns, or maybe additional stimulus payments, what the last few rounds of these government payments coming out have been based on tax return records. So we want to make sure that people are a part of this system so that they're getting those payments efficiently and effectively, and being able to apply them so that the purpose of those payments is lived out and people are actually receiving them. And when we're thinking about getting ready to file, some folks who haven't done it a lot in the past are really concerned about what to get ready, but also general populace, people who do file every year, these are some good tips. Anything that you get in the mail that says important tax information on it, keep that in a pile ready to go for when the taxes are being filed. There's also a number of financial accounts, bank or credit union accounts that have interest being earned or interest being paid. So maybe a mortgage or a student loan. It could be a savings account that earns interest. All of those financial accounts are likely to have tax documents associated with them. A lot of companies don't send those out in the mail anymore. And so having people jump in and check online accounts for tax forms is a really important step. Last year's tax return is a very important document when people are filing, whether they're filing their own tax return or working with somebody else to get their return filed. And then direct deposit or direct debit information is also a really good thing to have. If people are getting a refund back, to get it directly deposited into an account is much more efficient than having the IRS mail a check to someone. And the direct debit information would be if somebody owes money, additional taxes when they file their tax return, being able to pay that directly is an option and speeds up the processing time, ensures that somebody's taxes are paid on time, so they don't have to worry about sending a check or money order through the mail to the IRS, which is, and the IRS is a little behind on processing anything that comes in via paper. So this is a lovely way to connect those dots a little more quickly. Then we want folks to choose the best tax preparation method that works for them. I work at an organization that does free community tax preparation. We're a part of the Volunteer Income Tax Assistance or VITA program, and those programs exist across the country. I'll acknowledge that the pandemic has made it difficult for a lot of these volunteer-based organizations to have the same capacity that they have had in the past. So online tax preparation for free is a really good option for a lot of people if they're up for doing their own tax return. And there are a number of organizations that offer support to filers that are doing their own tax return, so that help is just a phone call or an email away when people are working through it on their own. And then having a paid tax preparer is also another option. My top tips with that is that people contact the preparer ahead of time and be clear about what the fees for tax preparation are. If someone has a special situation, explaining that to the preparer in advance to make sure that they're qualified and understand the tax situation is also a really important part of that process. And then I want to touch a little bit on deadlines because those are really important with taxes. Our tax season starts usually in late January or early February every year, and returns are due in mid-April. And I did see somebody had a question in the chat related to penalties and things like that. We can dig into that a little bit more, but in general, if people are filing late and they have a balance due. So if somebody is filing, they hadn't paid enough taxes during the year, now we're looking at settling up essentially when the tax return is filed. If they owe money at that point and they file late, then they are going to have penalties and interest added onto the tax return. But if somebody has a refund due, there's no penalty for filing late. There's no red flags that go up, nothing like that. Someone can file a tax return with a refund up to 3 years late and still claim that refund, no penalties at all. The one challenge here is if they file after that 3-year period, they're not going to have the refund issued. It's just expired essentially. And that refund money has kind of already been spent on the public good. You can think about it that way. But people have a 3-year grace period in which to claim a tax refund. And if folks have a balance due on a return, interest and penalties will just continue to be added to that return until it's filed and the tax amount is paid.